Most people who own a pension in the UK think of it as an entirely separate financial world from the property market. You save into it, it grows over time, and whatever happens to house prices is largely irrelevant to whether your retirement is secure. That assumption is increasingly wrong, and for a specific and growing subset of UK pension holders, it is wrong in a way that is going to become considerably more visible over the next few years. Because a meaningful share of the money sitting in UK workplace pension funds has been quietly allocated through a combination of direct property investment, mortgage-backed securities, and build-to-rent equity stakes to the exact segment of the UK property market that is currently under the most structural pressure: residential flats. I have been tracking the UK property and investment market for years, and the connection between the flat market crisis I have covered extensively on this channel and the pension savings of people who have never owned a flat and have no intention of doing so is one of the least discussed financial risks currently building in the background of the UK economy. In the next few minutes, I'm going to walk you through exactly how this exposure works, which types of pension are most affected, and what this means in practice for people thinking about their retirement savings right now. I want to be direct at the outset about what this video is and is not. It is not a prediction of pension fund collapse, and it is not a recommendation to make any specific change to your pension. It is an explanation of a genuine, currently under-acknowledged connection between a property market sector under significant structural pressure and the retirement savings of people who may not realize that connection exists. Let's start with how pension funds come to own residential property exposure in the first place, because the mechanism is not always direct or obvious. The most straightforward route is direct property investment, where a pension fund allocates a portion of its assets to a property fund that owns physical buildings, including residential buildings, either directly or through a property investment trust. A second route is through mortgage-backed securities, financial instruments that pool together large numbers of individual mortgage loans and sell the resulting income stream to investors, including pension funds, meaning a pension fund holding mortgage-backed securities is effectively exposed to the performance of the underlying mortgage book, including the creditworthiness of the borrowers and the value of the properties securing the loans. A third route, and the one that has grown most significantly in recent years, is through build-to-rent equity investment, where pension funds and other large institutional investors have taken direct stakes in residential build-to-rent developments, providing equity capital to developers in exchange for a share of the rental income and eventual capital value of completed blocks of flats. The scale of this institutional involvement in UK residential property is larger than most people realize. Some estimates put the total institutional capital committed to UK residential property across all routes at tens of billions of pounds, making it a genuinely significant allocation in the context of the overall UK pension fund system, even if it represents a minority of any individual fund's total assets. Red flag number 1, the build-to-rent exposure that has grown fastest and carries the most concentrated risk. As I have covered in previous videos on this channel, the UK build-to-rent sector has grown rapidly over the last decade, fueled precisely by the kind of large institutional capital that pension funds represent. Legal & General, Aviva, and several major pension fund managers have been among the most prominent investors in UK build-to-rent, committing billions of pounds to residential flat developments, specifically on the basis that long-term, stable rental income from professionally managed residential property was an attractive match for the long-term inflation-linked liability profile of a pension fund. That investment thesis was coherent when it was made. What has changed is the performance of the underlying asset class. As I have covered in detail in previous videos, UK flat values, service charge costs, insurance premiums, and the broader regulatory environment for residential property have all moved in directions that are compressing the return available from residential flat investment. And the write-downs that pension funds are beginning to apply to their residential property allocations are showing up quietly in footnotes of annual reports that most pension holders never read. Red flag number 2, the property fund liquidity problem that has already caused visible disruption in recent years. Property funds, including those held within pension investments, face a structural liquidity mismatch. The underlying assets, physical buildings, cannot be quickly sold if large numbers of investors want to exit simultaneously. But the fund structure typically promises investors some degree of ongoing liquidity. When property market conditions deteriorate and investor confidence falls, this mismatch can force property funds to gate redemptions, suspending withdrawals to prevent a fire sale of the underlying assets, an event that has occurred in the UK several times in recent years during periods of market stress. Pension holders, whose fund allocations include exposure to gated property funds, discover, at exactly the moment they most want certainty about their retirement savings, that a portion of those savings is temporarily inaccessible, not because of any fraud or mismanagement, but because of a structural feature of property fund investment that the original marketing rarely made prominent. Red flag number 3, the mortgage-backed securities exposure that is harder to identify but potentially more widely distributed. Pension funds that hold corporate bond allocations, which is a very large share of UK workplace pensions, frequently hold within that allocation some mortgage-backed securities, instruments that bundle together large numbers of UK residential mortgages and pay out the income from those mortgages to bondholders. As the UK flat market faces the combination of pressures I have covered extensively on this channel, elevated service charges, building safety issues, reducing property values, remortgage difficulties for flat owners, the credit quality of the mortgage pools underlying these securities is a live question. A material increase in defaults or arrears within the flat portion of UK mortgage books would affect the performance of mortgage-backed securities holding exposure to those loans, and pension funds holding those securities would feel that effect within their bond allocations, potentially without the fund manager or the pension holder having any specific awareness that flat market performance was the underlying driver. This indirect, layered exposure is arguably the most difficult type for an ordinary pension holder to identify or quantify, because it does not appear as a named residential property allocation in a fund fact sheet, but rather sits inside what is described as a fixed income or bond allocation, categories that most pension holders associate with stability and low risk, rather than with any direct relationship to UK flat prices. Red flag number 4, the valuation lag that means pension fund statements currently overstate the value of property-related assets. Commercial and residential property held within investment funds is typically revalued on a periodic basis, often quarterly or even annually for illiquid assets, rather than being marked to market continuously the way listed equities are. This valuation lag means that a deterioration in underlying property values shows up in pension fund statements with a delay, and the current quarterly or annual statements of pension funds with significant property exposure likely reflect valuations that were set before the most recent period of flat market weakness became fully apparent in transaction data. That means the number you see on your pension statement today, if your pension has meaningful property exposure, may not yet fully reflect where those assets would actually be priced if they had to be sold in the current market. Red flag number 5, the distinction between defined benefit and defined contribution pensions that determines where the investment risk ultimately sits. In a defined benefit pension, the employer promises a specific retirement income and bears the investment risk of achieving the returns needed to fund it. In a defined contribution pension, which covers the vast majority of people who have started a pension in the last 2 decades, the pension holder bears the investment risk directly, meaning that if the funds their pension is invested in perform poorly due to property market write-downs or property fund gating, it is the pension holder's retirement pot that takes the direct hit, not the employer or scheme sponsor. This distinction matters enormously for how much this issue actually affects any individual, and it is worth knowing clearly which type of pension you hold before assessing how much of the risk described in this video is genuinely relevant to your own retirement planning. Now, here is what connects all of these red flags together, and it is worth being direct about the level of risk involved. The exposure described throughout this video is unlikely for most pension holders to represent the kind of catastrophic risk that destroys a retirement fund. The UK pension system has multiple layers of diversification and regulation specifically designed to prevent concentrated single-sector exposure from producing that kind of outcome. What this exposure does represent for a meaningful number of pension holders is a drag on returns over the coming years as property-related write-downs work through the system, a source of interim volatility and liquidity risk in property fund allocations, and a connection between a sector of the property market that pension holders thought had nothing to do with them and the retirement savings they have spent a working life building. The risk is real, it is measurable, and it is currently under-acknowledged. I spoke with an independent financial advisor who works with clients on retirement planning, and off the record, her assessment was measured but clear. She said the question she is now starting to get from clients who have seen property market coverage on channels like this one is whether their pension is exposed to the flat market. And her honest answer is that for most people in a standard workplace defined contribution pension, there is some exposure, but the level and concentration of that exposure is not always easy to establish without looking closely at the specific fund's underlying allocation. She said the clients who are most exposed are typically those in older, more conservatively structured pension funds that took on significant property allocations in the period when institutional build-to-rent investment was being heavily promoted as a stable defensive asset class, and who have not reviewed or adjusted those allocations in recent years. She also made a point that I found particularly useful, which is that the issue is not symmetric across all age groups. For a pension holder in their 30s with 30 or more years until retirement, a period of property-related underperformance within their pension allocation is a manageable, recoverable event that the compounding of returns over a long remaining investment horizon can absorb without materially affecting ultimate retirement outcomes. For someone within 5 to 10 years of their retirement date, the same level of property-related drag or volatility has considerably more concentrated impact on the actual pot available at retirement, which is why the age-specific question of whether current property allocation remains appropriate is worth reviewing with proper regulated advice now rather than after the write-downs have become fully visible in the statements. So what does this mean practically? First, if you have a workplace pension or a self-invested personal pension, look at the specific fund or funds your money is allocated to and check what percentage is in property, either directly stated as a property allocation or within a mixed asset or diversified growth fund where property forms a component. Second, if you find a meaningful property allocation, ask your pension provider or financial advisor specifically whether that allocation includes residential property exposure, whether through a direct property fund, a build-to-rent vehicle, or a bond allocation that contains mortgage-backed securities. Third, if you are within 10 years of your planned retirement date and you have significant property exposure, consider with a regulated financial advisor whether that allocation still makes sense given the current performance outlook for the specific types of property your fund is invested in, because the risk tolerance appropriate for a 30-year time horizon is different from the risk tolerance appropriate for a 10-year one. Fourth, do not make any significant pension allocation changes based solely on this video or any single source of market commentary, because pension allocation decisions involve your specific circumstances, your other assets, your retirement timeline, and multiple factors that require proper regulated financial advice to assess correctly. Here is how I expect this to develop over the next few years. Expect the property write-downs currently appearing in footnotes of institutional fund accounts to become more visible in headline fund performance figures as the valuation lag catches up with actual market conditions. Expect the build-to-rent sector specifically to face a more scrutinized period as institutional investors reassess the return assumptions that justified their original capital allocation, with some funds reducing their residential property exposure in favor of alternative asset classes. Expect the broader conversation about pension fund property exposure to move from a niche financial media story to a more mainstream one as performance figures start to reflect current conditions more fully. And expect the regulatory conversation about how pension funds should disclose and manage property-related risks to intensify, driven by exactly the kind of visibility this type of coverage creates among ordinary pension holders who had previously not thought to ask where their money was actually invested. There is also a broader question worth naming here about the role institutional capital has played in the UK residential property market more generally, and whether that role has served the interests of ordinary people well. Pension funds investing in build-to-rent residential flats are in effect competing with individual buyers and renters for the same housing stock, providing capital that has funded the construction of large flat developments whose primary customer, once built, is not the owner-occupier but the institutionally managed rental tenant. Whether that dynamic has contributed to, or simply reflected, the affordability pressures and structural flat market problems covered extensively in previous videos on this channel is a genuinely contested question, but it is one that is increasingly being asked in policy circles, and the answer is likely to shape how institutional residential property investment is regulated and constrained over the coming decade. The uncomfortable truth is that the UK flat market crisis is not contained within the experience of people who own flats. Through the channels described throughout this video, its financial consequences extend into the pension savings of people who have no direct relationship with the residential property market at all, in ways that are genuinely difficult for an ordinary pension holder to detect from a standard annual statement. The right response to that is not panic, which would be disproportionate to the level of risk involved for most people. It is awareness and the specific, targeted question to your pension provider: where exactly is my money invested, and does any of it depend on UK residential flat values continuing to perform? That question takes 5 minutes to ask. The answer might tell you nothing that requires any action, or it might tell you something worth knowing before the write-downs start showing up in your annual statement, and the question of what to do about it suddenly becomes considerably more urgent and considerably less well-timed than asking it now while there is still room to respond thoughtfully rather than reactively.